Hi everyone, welcome to our presentation. We would like to take you a journey through our trading simulation experience. Over the past weeks, we have experienced a high dynamic market, tested different strategies, and learned how real-world factors such as geopolitical events and extreme weathers can shape price movements. To make this journey clear, we will first begin with our research and strategy development. This provides evidence for why we made certain trading decisions in the first place. After that, we will reflect on how these strategies play out during the simulation. And finally, we will share the lessons we learned as a team. So let's start with the first part, research and strategy development. I'll present our research on wheat market trend. Wheat is one of the three major global grains, and it plays a vital role in ensuring food security and stabilizing prices. It is also one of the most actively traded commodities, and its price volatility affects not only farmers and consumers, but also the food industry, the energy sector, and even overall macroeconomic stability. Looking at historical data, wheat price rose sharply between 2020 and 2022, reaching $440 per ton. The main driver was the Russia and Ukraine war, which disrupted Ukraine's wheat exports and created a global shortage of food. And after 2022, prices start to decline as markets adjusted to this supply shock. In the future markets, we observed a convergence problem, which is spot and future prices did not perfectly align at maturity, but the general trend remained consistent. Another important factor is seasonality. Based on the research in the report, volatility is typically higher during harvest seasons in summer and fall, and relatively lower during the winter. So from the consumer side, when wheat price rise, demand often shifts to alternative product like corn, which also shows similar but volatile price trend. Turn to current market conditions. Geopolitical risks remain critical. The Russia-Ukraine war continues to push up prices, while competition between the EU and Ukraine has shifted to North Africa. In addition, extreme weather events such as the recent drought in the UK are reducing production of food. These weather shocks often have delayed impact, meaning price volatility may persist over the next 1 to 2 years. From a sector perspective, wheat is essential for global food reserves and achieving SDG 2. However, climate change and geopolitical uncertainty are reducing reserves and raising risk of food reserves. Rising wheat prices also put pressure on food producers like bakeries and beer producers who face higher costs that are passed on to consumers. At the same time, agriculture is closely linked to the energy market. Higher crude oil price increase transportation and production costs, but also raising demand for biofuels, which further drives green demand. So in conclusion, the wheat market faces significant challenges from climate change, geopolitical tensions, and energy dynamics. By 2050, millions of people may face hunger due to these pressures. To manage risk, it is crucial to invest in resilient crop varieties, agricultural technology, and renewable energy. Most importantly, engaging in futures and hedging strategies will be essential to stabilize cost, manage volatility, and safeguard global food securities.
Okay, so now I will explain our trading strategy. Our main goal is to make wheat price more stable and reduce cost volatility. At the same time, we also want to support SDG2, which is about zero hunger. To do this, we use a hedging strategy with different tools. The first part is to take a long position in the December 2025 future contracts, which is ZWZ5. This helps us lock in a price forward. The second part is sprint trading. We use ZWN6 for intercouple sprint and the crop futures, ZCZ5, and this help us manage risk for the signal change and the substitution between the crops. We also add a cross hedging with the crude oil futures because engine price affect farming and the transportation cost. Finally, we use options such as bet-in calls or puts to predict agent express moves. We set our entry price at 530 cents per bushel. The X is contributed in the December 2025 for risk control. We keep a risk to reward ratio of 1 to 2. That means our profit target is 580 cents per bushel, and our stop loss is for 90 cents per boat. Our company needs about 50,000 each year. Each contract is 5,000. So we decided to hedging 50% of our need. So we need buy 5 contracts. So let's move to next slide. Okay, so to ensure success, we set a target return of 5% on our capital. This number comes from history, where price often move about 10% in 1 year. So a 5% return can help often that risk. We also limited our risk for each trade. We allow a maximum loss of 2% of our capital, which is 2,000 US dollars. For the whole portfolio, we maximum risk of 5%. So to track our performance, we look at a few keys. One is daily profit and loss. The other is return on investment for each tree and for the portfolio, of course, volatility. And next one is maximum drawdown and the short rate. We also check hedging efficiency if the variance of cost after hedging is smaller than before, then the hedging works. In short, if the number is less than 1, it is effect. Our process is simple. I would say it's like very simple. We record the results, calculate the industry, compare them to our targets, and then adjust our positions when it's needed. Okay, let's move to the next slide. Okay, so for SDG2, of course, our strategy also connect to the SDG2. If wheat price are too high, people in developing countries may not be able to afford food. In this case, we also short futures or buy put options to limit the price increase. If wheat price are too low, farmers may not earn enough income, so which means they reduce their motivation to produce. In this case, we can go long on future or buy call options to protect their income. So for this way, our strategy reduce extreme volatility and keeps wheat price in a fat rate. It protects consumers by keeping food affordable, and it protects farmers by supporting their incomes. So our strategy is not only about company profit, but also about the stability in the food system, which is the key idea of SDG2. So let's move next.
Okay, next part is about our trading. Our trading simulation was from the August 28 to September 3, with 100,000 US dollars at the international capitals. The main contract we focus on the December wheat future, ZWC5, because wheat is directly linked to global food security, and SDG2 to diversify, we also traded July wheat futures, corn futures, and crude oil futures, and some wheat options. Our objective were clearly to achieve at least a 5% return on investment and willing keep the risk of each trade under $2,000. And based on this, we used two technology analysis and one fundamental analysis to plan our trading. Every day, we recorded the profit and the loss of each contract. From the table, you can see that with future ZWZ5 rose as both string gain and large swings. For example, like on September 1, we earned more than $117 from the ZWZ5. At the same time, other contracts like the wings options created losses that reduced our portfolio result. This shows how important it was to track our daily performance clearly and how movements in the main contract will also influence the other countries like a contract like corn and crude oil. The portfolio profit and loss chart shows the story. On September 1, our portfolios spiked, but the next day we have the big drop before recovering slightly on September 3. This means the market is very volatile. And look at the position pie chart. At the beginning, our main contract, ZWZ5, dominated our portfolio. But over the time, we added more contracts like the corn and the crude oil. So the portfolio becomes more balanced. And the diversification helped us to reduce the risk and avoid depending on only one contract. To talk about our strategy. At the start, we increased on ZWZ5 long positions. The reason was fundamental. The food price index stayed at high levels, and the USDA report shows the supply risks. But later, technology signal changed. The Blinder band shows the weaker momenters, and the moving arrivals become the flats. At the same time, higher waste price increased our cost as the beer companies using waste as the raw materials. So we decided to reduce our positions. This allowed us to security profits while keeping costs under the control, still linked back to SDG2. To hedging seasonal and wider risk, we built an intra-commodity spread and holding ZWZ5 and also holding the ZWN6. When we saw possible correction signals, we even ate short ZWN6 contract. And we also made internal commodity spread ZWZ5 with corn futures, and corn is also a substitute for wheat. So when wheat fail, corn could help reduce our losses. This spread approach made the portfolio suffer and more diversified. And to diversify more, we used a cross hedging with the crude oil futures. Oil price affected agriculture cost, so this helped us balance energy and agriculture risks. We also used options. We bought put on ZWZ5 and ZWN6 to attract as a insurance, so we buy their put options. This means our maximized loss was limited to a premium we paid. However, not everything went smoothly. We made a mistake. We accidentally sold two ZWZ5 put options as the wrong strike. Luckily, the impact was very small, but it was a big lesson for us. It tells us the things and security is execution are just as important as strategies. Okay, let's move to the next part.
To part 3, investment portfolio analysis. Next.
Our portfolio began with the December 2025 with futures contract ZWZ5 at an opening price of 529 cents per bushel. During the observation period, the price rose to 531 cents, and our three-lot long position generated a floating profit of 300. Later, we expanded the portfolio by introducing other contracts, ZWN6 wheat futures for July 2026, ZCZ5 December 2025 corn futures, ZLZ5 crude oil futures, and also put options on both ZWZ5 and ZWN6. This diversified configuration reduced overall volatility. Options, in particular, played a key role by limiting downside risk to within 2% of total portfolio capital. The portfolio's core position was always ZWZ5 wheat futures, reflecting its importance as a benchmark in the wheat market. ZWN6 and ZCZ5 served as secondary positions. These were important for seasonal hedging and for capturing substitution effects between wheat and corn. We also included crude oil futures, CLZ5, which provided cross-sector diversification, and by adding exposure to the energy market, it strengthened the resilience of the portfolios, especially against rising transportation and production costs in agriculture. Although options accounted for only a small proportion of the portfolio, their strategic role was crucial. Near-term and far-month put options acted as insurance, helping us manage risk from short-term price swings as well as long-term uncertainties, such as extreme weather and geopolitical events. Our strategy adjustments followed three main dimensions: technical analysis. When Bollinger Bands show prices approaching the upper band around 534 cents, we reduced positions to lock in profits. When short-term moving averages flattened after crossing the long-term averages, this signaled weakening momentum, and we also cut risk exposure. Next is fundamental analysis. USDA reports indicated declining global wheat reserves, which supported adding to ZWZ5 positions. Winter weather risks increased premiums on far-month contracts, so we bought ZWN6 for seasonal hedging. Rising wheat prices boosted corn demand, justifying the inclusion of ZCZ5 as a cross-commodity hedge. Crude oil futures CLZ5 were included to hedge against higher energy costs that directly affect agricultural production. Last is option allocation. We purchased put options on ZWZ5 and ZWN6. This ensured that the maximum loss per trade stayed within 2,000, in line with the portfolio's capital management principle. This portfolio was not only about financial profit, but also about contributing to broader sustainable objectives. First is SDG2, Zero Hunger. By using stop loss and stop profit levels, we help stabilize wheat prices, making food more affordable. Second is SDG8, design work and economic growth. Our risk management prevented sharp price collapses that could harm farmer incomes, supporting sustainable agricultural livelihoods. The last is SDG 12, responsible consumption and production. diversifying across futures, options, and sector reduced extreme volatility in the food market, promoting a healthier and more stable trading environment. In conclusion, the portfolio demonstrated steady profit performance throughout the simulation period while strictly meeting its risk control targets. The integration of technical and fundamental analysis effectively guided decisions on increasing or reducing positions. Meanwhile, cross-asset and cross-sector allocations enhanced the resilience of the portfolio against market shock. Overall, this strategy allowed us to achieve both financial returns and alignment with sustainable development principles, highlighting a balanced and responsible investment approach.
That's all. Thank you for listening.